China poses the most serious long-term challenge to the international
After more than
order. Why is
2
he
months
saying
of a brutal citywide lockdown, Shanghai
China's
is
heavily
finally
indebted real estate
cracking open
sector
the
has
seal.
been the subject of intense
7%. Now, the Chinese property market has been shaken in recent months.
It's no secret that China's economy is collapsing as I speak. China is implementing the strictest COVID lockdown in history, but that's just the tip of the iceberg. Housing sales are crashing, the stock market is tumbling, the Chinese yuan is being devalued, social unrest is erupting, and the credit market is falling apart. China's economic failure isn't just a typical recession, it's the biggest property downturn in history and a serious threat to the global economy. Every economy relies on the consumer to drive economic growth. China's consumers are in the worst position in history, and I'm not exaggerating when I say that. China's consumer confidence index is currently the lowest it's been in the history of the index, which dates all the way back to 1991. The reason why this is extremely concerning is because it creates a terrifying feedback loop. One man's spending is another man's income. If consumers are not spending money on goods, then consumers are not going to receive income. For instance, an employee working for Didi spending less money on Alibaba.com will lead to less profits for Alibaba. This causes employees of Alibaba to be laid off or see their salaries be cut. The result of that is less money spent on another company's products, which only lowers income even more. If you're a Chinese citizen, this is a frightening situation to be in. The worst part about it is that the government is responsible for the country's failing economy. China's zero COVID policy, which involves trying to keep COVID cases at zero, has crashed the economy into pieces. The Chinese government has a goal of literally reaching zero COVID cases. That's right, zero COVID cases. We all know that's not possible when China has a population size of 1.4 billion people. This is why authoritarian governments can make terrible decisions. When the government has an unreasonable target like zero COVID cases, the government will enact any regulations to help reach that target. In order to do almost anything, citizens are forced to have a negative test within the past 72 hours. We're talking about riding a train, going shopping, eating at a restaurant. All of this will require a negative COVID test. This would be fine if getting a test was easy, but when you have 16 million people in one city trying to get tested, it's no surprise that testing lines are packed. So as a result of COVID testing regulations, people can't go shopping, they can't go see their family, some can't even go to work. This is already horrifying, but forced lockdowns are even worse. The entire city of Shanghai, which has a population of 26 million people, was forced to lock down for 70 days after a COVID breakout occurred. Some might think that the lockdown has subsided now, but the COVID regulations aren't over. One single COVID case in the city of Shenzhen forced large portions of the city to undergo mass testing. Imagine neighborhoods of people being forced to test just because one person got COVID. Such a strict protocol is ridiculous. Perhaps one of the most serious implications of the COVID lockdowns includes a further downfall in China's housing market. The Chinese housing market is one of the biggest bubbles in history. It's so massive that some might wonder how it came to be in the first place. Allocating capital to investments is extremely important for any citizen. Nobody wants to look at their cash rot away to inflation over time. As a result, a typical person might take a look at the stock market, but Chinese stocks are notoriously risky. Companies like Didi, the largest ride-hailing company in China, have seen their valuations tank by 75 to 90% just because of the Chinese Communist Party. The entire $1 trillion education sector went to zero overnight as the government turned the originally private industry into a public one. The Chinese superstar entrepreneur Jack Ma was torn apart after mysteriously disappearing for 3 months. And to make matters even worse, the Chinese government has scared away international investors by keeping the risk of a delisting on the US market. These delisting risks are only continuing to grow as time goes on, so stocks aren't really an option for Chinese citizens to invest in. But what about other assets? The vast majority of other assets are not even available to invest in. Just take a look at Bitcoin, which experienced a nationwide ban in 2021. The only place for Chinese citizens to invest in is the property market. The problem with this is that there is too much capital looking for too little opportunities to invest in. Because Chinese citizens have nowhere to invest their money, a bubble has formed in the real estate market. Property developers have taken out billions of dollars of debt to quickly expand their real estate portfolios. From their perspective, taking out debt seemed logical. Chinese real estate prices have been increasing year after year with little to no downturns. The debt pile has bubbled up for so long, and the government supported it the whole time. And as long as the government supported the increase of leverage, the size of the bubble only continued to grow. 65 million empty homes can be found across China in what's known as ghost cities. These cities contain houses that are there purely for investment gains. Nobody lives in them because the ghost houses are literally just there for future capital gains. Investors were going to pass on the ghost houses generation by generation until what happens recently. The government can decide to crash the market at any time that it wants, and that's exactly what the CCP has done. President Xi has recently been talking down on real estate as investments as if he didn't support it over the past decade. To crack down on the property market, Xi has been implementing what is known as the 3 red lines. The 3 red lines put a cap on the amount of debt that property developers can have. If a property developer crosses 3 red lines, 0% debt growth is permitted. This is a serious issue for a significant amount of property developers because they need to pay their interest payments somehow. Companies like Evergrande used to simply take out more debt to pay off their interest, but that's not possible anymore. Evergrande has already crossed all 3 red lines, which means that they cannot take out any more debt. The only possibility left is to sell properties to pay off the debt. But who's going to buy the properties? Property developers certainly can't, as they're all trying to scramble to the 3 red lines. Not only that, but nobody wants to buy properties in a sector where the CCP is purposely crashing the market. An increasing number of Chinese property developers are now on the brink of default. In the 2009 Asian financial crisis, the bonds of 3 Chinese property developers were deemed as risky by Moody's research. That number is now increased to 24. The housing bubble didn't just appear out of nowhere. It was built over decades of growing liabilities. Debt levels in the property sector increased from $100 billion to over $1 trillion from 2010 to 2019. That is a 10x increase in debt in just 9 years, which is certainly not sustainable. The central Chinese bank has tried to support the housing market by cutting mortgage rates, but that clearly hasn't been very effective so far. Lowering interest rates in an over-leveraged market is like giving cigarettes to someone with lung cancer. It's already a serious problem, and the government's recent actions only worsen the problem. Sales of residential buildings are down over 41% year over year. Such a frightening drop is unprecedented and exceeds that of 2008 and 2014. One of the biggest Japanese financial companies, Nomura Holdings, called this the worst property downturn on record, which isn't even an exaggeration. The number of rating cuts on Chinese developers is also at an all-time high, with rating cuts still continuing to happen right now. Property developers are stuck with the overwhelming problem of debt, and they have no way to pay it off. Even the ones below the 3 red lines are still doomed to fail inside an environment like this. So why is this all important? As mentioned previously, real estate is the only asset class that Chinese citizens can invest in. Economists value the Chinese real estate sector at $55 trillion, almost 3 times more than the entire US GDP. Real estate and related sectors account for roughly 28% of China's total GDP. A 50% drop in Chinese real estate could easily cause a global recession. China accounts for over 18% of the global GDP, so an economic slowdown in China could cause global weakness. Some might think that China's crash is a short-term issue, but that's not quite true. China's economic collapse isn't just in real estate. Some economists marvel at China's astonishingly quick GDP growth, but they fail to see the underlying issues that were created. All of China's economic growth was fueled by a disproportionate increase in debt. China was once a country with relatively low debt levels, but the country's total debt has quickly grown to almost 4 times the entire country's GDP. The credit market is already faltering as a result of China's overextended debt levels. Lenders don't want to lend out money in an economy that is struggling to stay afloat. China's new loans have plunged to the lowest level in 5 years. The Chinese central bank is desperately trying to encourage lenders to boost loans, but the economic outlook is simply too grim to increase lending. The result of all these economic issues is the downfall of the Chinese yuan. Spurred by internal economic struggles, the Chinese yuan is currently undergoing the worst devaluation in history. While the US Federal Reserve is sharply raising interest rates, China's central bank is cutting interest rates as fast as possible. This is because unlike the US economy that appreciated in 2021 due to quantitative easing, the Chinese economy has no leeway to raise interest rates. The Chinese yuan to US dollar exchange rate has recently increased by a drastic amount. This graph shows the yuan per dollar conversion rate. This means that for every dollar, this graph shows the amount of yuan you would receive. You can see how recently the Chinese yuan has suddenly been devalued. The yuan per dollar has increased from 6.4 to 6.6 within an extremely short period of time. This means that for every dollar, you would get 0.2 more yuan than before. That might not seem like much, but it's the yuan's worst month in history. The last time a quick yuan devaluation like this has happened was in 2015. This came as many doubted China's free market commitment, as the yuan's currency rate was purposely manipulated to prop up the Chinese economy. The 2015 panic led to $1 trillion flowing out of the yuan. With the yuan currently dropping even more than 2015, we could see $2 or even $3 trillion in capital outflows out of the yuan. The reason why the Chinese government has allowed, if not encouraged, the yuan to crash is because it theoretically supports the economy in the short term. As the yuan becomes devalued, Chinese goods become cheaper. After all, if the US dollar can be exchanged for more yuan, then more Americans will purchase Chinese goods. The issue with a currency devaluation is that export-driven economies will suffer. Because India had to compete with China for exports in 2015, the Indian currency plunged to a 2-year low. China's yuan devaluation could bring down the entire emerging market with it since they rely heavily on exports. So just like the US Federal Reserve printing money in 2021, China's currency devaluation is setting the stage for a massive economic collapse. China's government knows this too well, but just like an addictive drug, they can't stop stimulating the economy. China recently released a package that contains 33 new stimulus measures. The total stimulus amount has now increased to $5.3 trillion, which is even more than that of 2021. A breakdown of this stimulus will show you that most of the budget comes from 26.7 trillion yuan in general budget expenditures. China will tell you that this spending is for a temporary COVID breakout, but they're just trying to cover much more serious issues. Those of you who don't live in China might think that you're protected from China's collapse. The device you're using to watch this video on was probably made in China. China is a manufacturing superpower that accounts for roughly 28% of manufacturing globally. A sudden crash in China's economy will put substantial strain on manufacturing worldwide. With a lower supply of goods, countries worldwide will experience much higher prices all across the board. The continent that will face the worst impact of them all is Europe. The European Union depends on China for almost all of its metal. China accounts for roughly 75 to 100% of the EU's total metal supply. Out of the 30 critical raw materials, 19 of them mainly come from China. One instance of this is magnesium. China supplies 98% of the EU's magnesium supply. Imagine what's going to happen when 70 to 90% of the metal supply suddenly fades away. Commodity prices will skyrocket, causing even more strain on the EU as well as other economies. Let me know what you think about China's economic collapse. Are you concerned at all? If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.